Hi, and welcome to my monthly market insights video. My name is Dan Timotich. I'm a managing principal and a portfolio manager at T2 Asset Management. Before we get started, just a reminder, this video is for educational purposes only. Opinions expressed in the video are mine and do not reflect the opinions of others. You should always consult with your financial advisor before making any decisions. Investments involve risk and are not guaranteed. But before I get into my outlook, I just wanted to extend my condolences to the families of the 13 brave men and women we lost in Afghanistan last week. I live in a community that is heavily populated with military families, and this loss has certainly hit home here in Florida. We want to thank you and honor you. Okay, so looking ahead now into the video, I think there's a little attention being paid to the risks associated with the enormous spending that has happened over the past year as we tried to move past the pandemic. Trillions upon trillions of dollars have been spent. The Fed is monetizing our debt and keeping interest rates far too low. This month, I'm going to try to outline some of the possible risks that are associated with these policies. We are currently or increasingly headed into a environment called stagflation. Now, some of you may have heard of stagflation, but here's the actual definition. Persistent inflation combined with stagnant consumer demand and relatively high unemployment. In essence, it's an environment where prices are high and rising and demand is slowing. This is a difficult situation for the Fed as we remember back to the 1970s going into the 1980s. So this month I want to talk to you about the contributing factors that could lead us into the same stagflation environment. And in order to understand stagflation, I think we need to understand inflation, you need to understand employment, Fed policy, economic growth, and how all of these things impact corporate earnings, which in essence is stock market performance. One thing to keep in mind, the Fed is charged with two basic responsibilities: aim for full employment and maintain price stability. So as you watch this video, ask yourself if the Fed is achieving those two mandates. Okay, you don't really need this chart to know inflation is here. Just go to the grocery store, go to Home Depot, go fill up your tank with gas. Inflation is running high, and you can see it here as it has recently surpassed 5% on a year-over-year basis. Looking at a longer time period, we can see that inflation hasn't been this high since the financial crisis of 2008. Remember that? What was going on back then? Well, throughout the early 2000s, the Fed kept rates far too long, claiming that inflation wasn't a problem because it was offset by productivity gains. This led to a bubble in housing, which led to creative Wall Streeters issuing highly leveraged collateralized debt obligations, which led to investors taking on too much risk. Once the music stopped and people began defaulting on their mortgages, all hell broke loose. Well, today, there are some similarities. The Fed is without question too accommodative and claiming inflation is transitory. The housing market is on fire, and it very well could be in a bubble. And we have all seen Wall Street once again get creative with the growth of SPACs. These are special purpose acquisition companies where Wall Street raises money from investors and buys these private companies. Because money is so easy in today's environment, many of these companies are being bought by these SPACs at way overvalued levels, and they may not even turn a profit for many, many years in the future. But who cares? SPAC sponsors don't care. They make a lot of money packaging these deals, and if things don't work out, it's the investors that are going to feel it. It's not them. As a side note, I happened to take a look at the SPAC index from CNBC. That index, post-SPAC index from CNBC is down about 30% this year, and we're starting to see lawsuits on these SPACs starting to increase. Okay, looking at employment, one of the Fed's mandates, of course. We hear a lot about the unemployment rate. Most economists, they come up with some unemployment rate to claim full employment, which is a problem since it really doesn't tell you anything. An unemployment rate of 4%, for example, may or may not be full employment. What if hundreds of thousands of people just gave up looking for a job and left the workforce? That would make the unemployment rate low, but it would be far from full employment. I prefer to look at charts like this. The red line is the actual number of unemployed people, and the blue line is the number of job openings in the economy. As you can see today, we have more job openings than the number of unemployed people. To me, I consider that full employment. It means if someone is unemployed, they can find a job. It may not be their dream job, but it's a job. And the Fed's job is not mandated to make sure everybody gets their dream job. Same thing here. From 2018 up until the pandemic, we were at full employment, and yet the unemployment rate kept moving around, and it even ticked up a few times as the people re-entered the workforce. So I caution people about looking at the unemployment rate that they publish. I would be much more concerned and much more focused on how many people are unemployed, how many jobs are available for those people to take. And I think that gives you a better picture of the employment picture. So back to the Fed's mandates of full employment and maintaining price stability. Well, I think they've achieved full employment, so good for them. However, I think they're failing on the price stability or inflation. Jerome Powell keeps preaching today that inflation is transitory, and some of it is. But I believe that inflation is significantly higher than what's being reported, and there are a lot of components of inflation that will persist, including wages, raw materials, commodities, etc. Unfortunately, the Fed has created a monster with its zero interest rate policy and its balance sheet expansion that it has no choice but to keep feeding this monster and justify their policies in whatever way they can. And calling inflation transitory, well, that's just one of the ways they could justify it. So let's take a look at the Fed. In my opinion, the Fed is well behind the eight ball and has been for some time. Here we have a chart showing the total debt of the United States. We're about to hit $30 trillion, especially after this ridiculous infrastructure bill passes. And if they do go on and pass the $3.5 trillion bill as a supplement, we're going to be well on our way to $35 or $40 trillion in debt. And with the growing debt level, the Fed has decided it's going to need to monetize the debt. The Fed's balance sheet has exceeded $8 trillion. You have to remember, prior to the financial crisis of 2008, the Fed's balance sheet was only about $700-800 billion. Today, it's 10 times that size. And just one more way to look at it, the amount of money we're borrowing now exceeds the level of output for the entire United States. In other words, we have more debt than the entire U.S. economy, and by a lot. The debt to GDP ratio is now 126%. And just so you know, France has a debt to GDP ratio of about 115%. France is more fiscally responsible than the United States. I'll let you stew on that for a bit. So, why does all this matter? Who cares if we're monetizing our debt? Who cares if the Fed keeps printing money? Well, it matters because just like Newton's third law, for every action, there's an equal and opposite reaction. Government overspends, and we start running larger and larger deficits. As such, the Fed starts printing money, and the money supply grows. As that continues, obviously, our debt grows. Well, in order to service this growing debt, the Fed's going to start buying its debt and keep interest rates really low, allowing even more spending in Washington. In essence, the Fed's policy is enabling more and more spending. This all leads to inflationary pressure as our currency gets devalued and the cycle starts all over again. Now, some of you may be wondering, well, if the cycle just repeats, who cares? Well, the cycle must break first. It will need to break one of two ways. The optimistic way is that the Fed achieves its inflation and employment targets. They're right about everything. GDP will grow, and a roaring economy is going to allow government to service its own debt without the help of the Fed. I think this is an extremely unlikely scenario, so we have to turn to option B. Inflation is real, and it's high. It will lead to weaker demand as people can't afford goods and services. The economy slows. Debt keeps piling on, and to service the debt, the Fed will continue to monetize the debt. I think this is the more likely outcome. And in this outcome, just like it was in the early 80s, the Fed's going to be forced to raise rates faster and sooner to fight inflation during a time when the economy is slowing. This would mark the beginning of stagflation, and it'll mark the end of the longest bull run in history. So let's take a look at the economy. We hear all the time the economy is great, earnings are on fire, the Fed is on your side. Well, we have certainly come a long way since the economy was completely shut down last year, but you would expect that given how much money has been plowed into the system. Whenever you throw $10-20 trillion, a lot of good things are going to happen. But eventually, the economy is going to have to stand on its own. Here we have a chart from the Atlanta Fed showing its estimates for the third quarter. As you can see, they have been lowering the estimates since mid-year. In July, they expected 6.1% growth. By August 6th, it was 6%. A few weeks later, it's down to 5.1%. And yesterday, they released their newest estimate of 3.7%. So I ask you, is inflation rising or falling? Is the economy growing or slowing? These are important questions, and the Fed's going to need to deal with them sooner, hopefully, rather than later. So what does this all mean for earnings and thereby the stock market? We start by looking at supply chain. We all know about bottlenecks in every part of the world, but I want to walk you through just a real basic supply chain. It all starts with raw materials that are used to manufacture stuff that is sold to wholesalers, who in turn sell it to retailers so that the consumer can finally get their hands on it. Each of these basic stages requires the operators to make a profit and a profit margin. As inflation takes hold, the cost of these goods goes up. Depending on where in the supply chain inflation hits, makes a big difference. For example, we all heard about the shortages of semiconductors. Semis are basically in the manufacturing stage. So, semiconductor prices are expected to go up 20%. That means for wholesalers to maintain their profit margin, they're going to need to raise the prices to the retailer. The retailer needs to keep their profit margin in effect, so they're going to raise their rates as well. And finally, the consumer sees a huge price increase. Now, at first, these price increases, they don't really matter much, but corporate earnings typically end up growing. The margins continue to look really good. However, at some point, the consumer will push back and not buy these inflated goods or services. That's when corporate revenues start to slow and margins start to decline. The pushback from the consumer is what's going to cause companies to report weaker earnings, and that's going to lead to slower economic growth, and unemployment obviously increases as part of that. So, there are some storm clouds forming, but not all storms are going to be a Katrina or an Ida. But it's important to know when they're headed your way. You watch how it's developing, you prepare for different outcomes, and in many ways, investing is the same as kind of preparing for a bad storm. We just went through a number of factors that show us some early warning signs. It doesn't mean that we're going to be in the direct path of a Category 5 hurricane, but it does mean that we should be prepared to react to the realities that we're faced with. In the 1970s, we had stagflation. That forced Fed Chair Volcker at the time to hike rates much higher and much faster, which inevitably pushed the U.S. economy into a recession. In the late 90s, we saw that what was going on with tech stocks, everything associated with the internet went up, even companies that had no product, let alone profits. It's different this time was the repeated phrase among so-called experts on TV. In the late 2000s, we saw what can happen when housing bubbles develop and Wall Street gets creative. Today, we may have all three of these things converging. Will it be as bad as it was back then? Nobody knows. What I do know is that when storm clouds are on the horizon, the last thing I want to do is hop on a boat and go 50 miles offshore fishing. Maybe the Fed will be able to navigate this narrow path. Maybe today's Reddit traders are not like the day traders of the late 90s. And maybe SPACs are totally different than collateralized debt obligations. At this point, given fiscal and monetary policies, slowing growth, peak earnings, high valuations, and inflation, I think it's only prudent to reduce risk, and that's why I've reduced my stock exposure to 56%. We may not get a direct hit from the hurricane, but I'm pretty sure we're going to have some heavy winds and rain in the coming months. Well, I hope this month's video was helpful. I do these videos so I can help investors see things a little differently. There are a lot of people that will go on TV and push their specific strategies and talk their book, like they say. I'm pretty simple in that way. Sometimes I think it makes sense to be fully invested, and at times it's better to just play defense and wait for conditions to improve. So if you have any questions, need a second opinion, feel free to give me a call, shoot me an email, whatever's easier. I'll be more than happy to help. Until next time, thanks for watching.